Hey guys, thank you for tuning in to another edition of Tuesday Morning Coffee. Today, with great pleasure, I've got a good friend of mine and a guy that helps me quite a bit, Ronnie Martin with MidSouth Bank. And Ronnie is in commercial lending. But mainly, Ronnie specializes in new construction, income-producing properties. If you got any rentals, 1 to 4 is kind of his wheelhouse, whether it's a single family or a quadruplex. And then also development loans with MidSouth, and they're a local bank. And Ronnie and I have been working together probably about 5 years now, and I can say that he is one of the better bankers that I've ever dealt with. He gets things, he looks at the big picture, and has a lot of great ideas, which is very refreshing in that industry. So, Ronnie, thanks for coming on, man.
My pleasure. Appreciate the invite.
We talk a lot about real estate. Your job, obviously, is to bring good business to your bank. Right. So you're one of the few bankers that I can talk to that really kind of digs in there and tries to understand statistics and what's going on in the market and trends and things like that. And before this segment aired, we were talking a little bit. We were talking about distressed property because you have tracked that for the several years. It's been a big topic. There's been a lot of foreclosures, a lot of short sales.
Right.
Tell us a little bit about what's going on in distressed properties, the best you can tell. Do you think we're kind of easing out of them a little bit? Do you think they're kind of going away? And kind of give me some of your data that you follow and what that's saying.
Well, appreciate the kind words.
Sure.
Very much so. Enjoy our working relationship. Part of what I've done out of necessity, when you meet with a client, whether it's a construction loan or an income producing loan, trying to understand the risk of that transaction is critical. And one of the things I learned early on was understanding how you get out of a transaction, which means if the worst case scenario, we have to sell this piece of property in a distress situation, what can we expect it to sell for?
Right.
And so that led to looking at what banks were selling properties for, what were investors willing to pay for a property, what were end users willing to pay. And as I started tracking this data, it helped me give add some value to clients that I worked with that said, hey, in a downturn like we had in 07, 08, 09, and we're still digging out of, what can you expect if something bad happens? You have to liquidate this property. What can you expect? Well, what I've seen is in 2012 we've gotten about a 6% lift on the distressed property sales, and as we talked earlier, I kind of look at the market as being segmented into 3 segments: the distressed property sales, new construction, and the resales.
Right. And
they're all a little different,
sure.
Requiring a little different expertise. But the good thing is, for people that are income-producing property holders that choose to invest in those properties, as you're getting cash flow, as you're getting an income stream from the property that's being generated, you're also getting some lift in the value of those properties. And so that's what's important in the takeaway.
Sure. What, obviously, I know you well enough, so I know that you own some investment property yourself. You're a big believer in investment property. I think a lot of people have fear about investment property. Like anything, if you don't know much about it, there's some fear involved. Sure. But just so people out there know that maybe been thinking around, been looking at their 401k for the last 20 years, and they're thinking about maybe doing something different. If someone came to you tomorrow, Ronnie, and they said, I found a little house I might want to make an offer on. I'm going to make it a rental. What would you advise them on, or what would they need to know? Perhaps better question. What would they need to know that they would have to put down on this home? Sure. Just some basics like that that might help our viewing audience.
A pretty standard place to start is most financial institutions are going to want you to have some equity in that transaction. Generally, that number is 20% of your purchase price.
Right.
There are a lot of other rules and details, but that's an easy, quick number to keep in mind. So on a $100,000 property, you'd be putting $20,000 down.
Right.
But what I tell people all the time, the really important thing to look at is if this property is going to be an investment, well, then I need to look at the income that the property is going to produce.
Sure.
So many people get caught up on, and rightfully so, how much does it cost? What kind of discount am I getting on the property?
Right.
Very important, no doubt.
Right.
However, regardless of the deal you get on the property, if you don't know what income stream, what rents you're going to be able to get out of the property, then it's really hard to classify that as an investment because you don't really know if it's a good investment or a bad investment.
Right.
You know you're getting a deal, based on the last sales price. So I walk my clients through a process and say, okay, very, very quickly, we can do it in minutes. What's your purchase price? How much of that are you going to borrow from the bank? What's your rental income going to be? And then let's add in taxes and insurance, and let's look at what our cash flow is going to be.
Right.
If that's covering your payment and taxes and insurance based on the price you're paying for the property, and this is where I really try to encourage my clients to do this, to put a structure in place where it's a 15-year amortization.
Sure.
And that's really geared towards making it an investment.
Right.
Because if you can't cash flow a property on a 15-year amortization, it doesn't mean it's a bad property.
Right.
But what it means is it's not as good of an investment.
And if that can't happen, then you're going to want to see some outlying factors on that borrower's behalf. Hey, they've got some money sitting over in the bank for a rainy day.
Exactly.
And things like that. I've always kind of come from that, and I can't remember who told me this, but some wise investor that you want to try to buy a property where if you put it on a 15-year note,
right,
it'll pay for itself.
Absolutely.
And you may have to understand, you may have to go in and put a central heating area, you may have to do some painting out of pocket, but if you can get it to that 15
Absolutely.
years, then that's you get somebody to pay that property off for you in 15 years. That's a pretty good little work. And in our market, like you said, somebody could get a great deal on a $300,000 house. It could be a great buy.
Right.
But if the daggum thing only will rent for $1,700 or $1,600,
right,
it's just probably not going to work on a cash flow basis. Doesn't mean they may not be able to resell it next year for more money, but it just so there is a fine line, especially in every market. But in Rutherford County, there's a very fine line in kind of your optimal what you need to buy in home and what it will bring in rent and that kind of thing. Well, that's good stuff, man. I appreciate you so much. If any of you guys out there are needing a good local banker that'll talk to you, look at you, treat you, tell you the truth. And sometimes Ronnie tells me the truth and keeps me out of my own way, and really helps me. Sometimes hearing the truth is a very good thing. But by all means, is always looking for the opportunity to try to make the deal work if it makes sense.
Absolutely.
This is a good man to go to, Ronnie Martin. Thanks, buddy. I appreciate you coming on.
Absolutely.
All right.